Prisma Enterprises. The following information appeared in the accounting records of Prisma Enterprises, a manufacturing entity, as at 28 February 2013. Extract from the trial balance as at 28 February 2013. And they give us a lot of information. Let's quickly just check what they want from us. They tell us prepare the following accounts in the general ledger: the raw materials, factory overheads, work in progress, finished goods, allowance for unrealized profit, and the manufacturing profit. Guys, the manufacturing profit is another word or another name for the unrealized profit P&L account. That is exactly the same thing. So manufacturing profit and unrealized profit P&L is exactly the same account. Good. So we can start off drawing our T accounts, T, and then we can start completing this picture. These questions are really very simple questions. Inventory in the beginning of the year, 1 March 2012. Raw materials 160650. So in our raw materials account at the debit side 160650. Work in progress, opening balance 229500. In our work in progress account, there's our opening balance 229500. Finished products 469200, and in our finished products account, here it is, opening balance 469200. Good, and then they give us all kinds of information for the year. They give us additional information. They tell us inventory is valid on the first in, first out method. Inventory on hand as at 28 February 2013. So this is closing balances. They say products are transferred to the sales department at a consistent profit percentage. And then they wara, and in number 6 they tell us at 1 March 2012, we're still at the beginning of the year. The allowance for unrealized profit in finished products inventory amounted to 61,200. So here in number 3, they don't give us the unrealized profit percentage, but we can calculate that. We have total finished products at the beginning of the year, which was 469,200. We know that the actual value or cost price of finished goods was equal to 469,200 less 61,200. So the actual cost price was an amount of 408,000. So if we take the 61,200 now and we divide it by 408,000, we will get the unrealized profit percentage, which will give us 15%. So here's also our opening balance for our unrealized profit as at the beginning of the year, 61,200. And we said, well, if we take the 469,200 less the 61,200, we're back at the actual cost price. And then the profit on the actual cost price equals 15%. So we know that we transfer these costs from the production department to the sales department at a profit of 15%. Good, now let's continue. Raw materials purchased including 52,326. Now number 5 said all indirect materials issued were used in the production process. So that means that there was all indirect materials has something to do with the production and all form part of the production cost. They also tell us that the raw material account in the general ledger contains both the receipt and issue of direct and indirect materials. So it's a combined account. 160650, there was nothing left at the beginning of the year, so that was our opening. So raw materials included indirect material. We're working with one account, so therefore we can account for the total of 511,326 in our raw material account. Purchases 511,326. Then raw materials issued to production, that is the big question mark. Air freight paid on raw material purchased in the Congo, 163,200. It's a purchase related cost. So in our raw materials account on the debit side, purchase related cost air freight, 163,200 rand. Then indirect materials additionally issued to production 6426. Now we're going to credit our raw material account because it's a combined account with a 6426, but very important, we're going to debit our overheads account with that amount of 6426. So overheads there on the debit side, indirect materials issued 6426. Right, insurance expenses, including 8415 for office insurance. So the portion of the insurance that relates to the factory will be the difference between the two, and that is also an overhead cost. So insurance here, 3294 less 8415 gives us a total of 21,879. Depreciation. They say there's a 10:3 ratio applicable for manufacturing equipment and office furniture respectively. So the total was 39,780. Manufacturing equipment would be 10 divided by 13 of the 39,780, and that is also overhead cost. So 10 divided by 13 multiplied by 39,780 gives us a total of 30,600. Then rent expense, a total of 84,150, 60% was for factory premises. Guys, then 60% of that will form part of our overhead and the cost of the inventory. But 40%, the remaining 40% is a normal operating expense. The same thing applies to the depreciation. 3 divided by 13 of that amount will be a normal operating expense in the income statement, depreciation on office furniture. Your normal rent would be 40% of the 84 as a normal operating expense in the income statement, although 60% of the 84,150 will form part of our cost of production, and that will be in our overhead account because it's an overhead, 60% of that amount, which gives us 50,490 Rand. Right, wages and salaries paid. 336,600. Now the question tells us that 30% of salaries and wages represent indirect labor, of which 39,780 Rand was paid to the factory supervisor. The rest of the salaries and wages relate to direct labours. Now, direct labour cost is a primary cost and it has its own account, which is closed off against work in process at the end of the period. Indirect labour is part of overheads, and that needs to be taken to overheads. Now, the cost of the factory supervisor is also an indirect cost, so it's no sense of splitting the 30% and taking out 39,780 and also show that as an overhead cost. So we can take 30% of the total amount paid for salaries and wages as overheads and 70% as direct costs, which will end up eventually in the work in process account. So indirect labour, 30% of the total of 336,600, and that we're going to show as an overhead. And then in work in process, at the end of the day, the direct labour would be 70% of the 336,600, i.e. 235,620 as part of work in progress. Water and electricity, 272,646 included for the factory water and electricity. So that's the total amount. We are only going to put the 272,646 as an overhead cost, and the difference between the two will be shown as a normal operating expense in the income statement, water and electricity. So 272,646, which will form part of our overhead cost again, 272,646, and that will be overheads. Great. Sales is sales, got nothing to do with production cost. Inventory is valued on the first in, first out. Inventory on hand as at the end of the year. Raw materials, closing balance 387,020, 387,090, sorry. Work in progress, closing balance 435,041. So in a work in progress account, closing inventory 535,041. Finished products 532,440. So in our finished products account, closing balance 532,440. Now let's complete the picture. Raw materials, we have all those amounts, we've got all those amounts, so we need a balancing figure of this account on the credit side. What does that represent? Raw materials issued to the production process, and that we transfer to work in process. So balancing figure 441660, and in our work in process account on the debit side, raw material 441660. Our factory overheads, we're just going to balance off this account. The total overheads was 483,021, and that we're going to transfer to work in process as well. So here in our overheads, in our work in progress account, 483,021. Right, now in our work in progress account, we now need on the credit side a balancing entry, and what does that represent? The actual cost of goods manufactured for the period at 54,760. So we will debit finished goods account and we're going to credit work in progress at 54,760. Remember, it is here where the factory stops. So when the sales department receive that inventory items which was completed, then they receive it at a 15% marked up price. So that 15% we still have to account for, and we're going to debit 15% of 854,760 equals 128,214. We debit our inventory finished goods accounts, and we will credit our unrealized profit and loss account, or our manufacturing profit, the other word for that, with a 128,214. Now, we can actually complete now our finished goods account. We have the closing inventory, therefore our balancing figure in this instance will be our cost of sales. So cost of finished goods sold during the year. Cost of sales 919,734. But remember, everything in the finished goods account is at a blown up price. So included there was unrealized profit. Included here you see the unrealized profit component. Closing inventory will have unrealized profit in. So therefore that cost of sales will also be, it's a balancing figure, everything's got unrealized profit, so that will also include unrealized profit. But firstly, remember that means we have to adjust our cost of sales at the end of the year to show the actual cost price of goods sold in the income statement, not the blown up cost of sales. Right. Now, our allowance account at year end must have a balance as well, because the 532,440, which we bring down here below the line of the debit side, includes this 15% unrealized profit. So if we want to determine the balance of the allowance for unrealized profit at the end of the year, it would be the 532,440 multiplied by 15 divided by 115, which gives us 532,440. Multiplied by 532,440, that gives us a total of 69,449 rather. So how are we going to increase our allowance account balance from 61,200 to 69,449? By crediting this allowance account with a total of 8249. The counter leg will go against our manufacturing profit or unrealized profit and loss account, 8249. Alternatively, we could have said 61,200 here on the debit side, 61,200 here on the credit side. We could have said 69,449 here on the debit side, 69,449 there on the credit side. What would the difference have been? It would have been a net debit on the unrealized P&L account of 8249. Doesn't matter which way you go, it gives you exactly the same answer, 8249. Now, the balance of the unrealized P&L account, the 119,965, that is actually being transferred to cost of sales, and that will then take care of the unrealized profit included in the 919,734. So at year end, our actual cost of sales in the income statement will be 919,734 less 119,965. And that would be cost of sales actually without any unrealized profit.